The Insurance Pro Blog Podcast, episode number 105. Your indexed universal life insurance assumptions are probably wrong. Hello and welcome. This is the Insurance Pro Blog Podcast. It is Thursday, April 12th, 2018. This is episode 105. I am Brandon Roberts.
And I am Brantley Whitley.
And I don't know. There's no real exciting way to start the day, I don't think. I mean, we're middle of April, so there's nothing. We can't say new month is here or anything like that.
Tax day's coming.
Yeah, thanks for lightening the mood.
Anti-excitement.
Mm-hmm.
Yeah, it's I know it's tough for anyone who's listening to think that we didn't have anything exciting to deliver in the world of life insurance.
Well,
usually it's so riveting.
Yes, you sort of took the words out of my mouth, or at least the thought out of my head. When you record a weekly podcast about insurance, you kind of have to figure out a way to jazz it up every time.
Yes, and
we're still working on that, by the way.
Yes, and we are masters of improv, because if you guys only knew the turds that we shape into diamonds on a regular basis, just for you, our listeners, to try to give you at least a smidgen of entertainment with your information.
Yeah.
So, in the world of life insurance entertainment, we are kings. I have determined. So, number one, we're going to brand that number one in the life insurance entertainment business.
I was talking to someone a couple weeks ago about something not related to insurance at all, and they commented that I have a certain intensity and excitement in my voice at times. And I told them, well, I produce a podcast and write articles on insurance. That's kind of my real gig. And when you do that, you kind of have to get used to speaking as if you're about to make some huge announcement. Otherwise, no one's ever going to listen. So
that is true. And by the way, you didn't have to tell me that you weren't talking to that person about insurance, because
that was kind of unnecessary.
Yeah. Well, you implied that they continued the conversation. And I was like, if you were talking about insurance, it would have been very brief.
Yeah.
Very, very brief.
Yep.
So today, we're going back to have a conversation that sort of circles the Index Universal Life Insurance wagon, right?
Right. This subject comes up from time to time, and the core question is, why do we assume the index credit interest rate that we do?
Right.
Which is a statement that I can make, and a certain percentage of the audience will know what I'm talking about, and another percentage will not.
Yeah.
So we'll back up and explain what all that is. When it comes to indexed universal life insurance, the interest rate is not fixed.
Right.
The interest rate that's earned on the cash value.
Mm-hmm.
It fluctuates, and it depends very much on the movement in the index that's being tracked.
Right.
So, really basic example with indexed universal life insurance, you could choose an index segment that follows the 1 year change in the S&P 500 index. We typically refer to that as a 1 year point to point in the S&P 500,
which is sort of the most common. I mean, that's
so what that looks like is from the beginning of the policy year to the end of the policy year, we look at what the percentage change is in the S&P 500 index. And whatever that change is your corresponding interest earned on the cash value up to a certain limit that we would call a cap rate.
Right.
So if, for example, the cap rate is, let's say, 10%, and the S&P 500 movement in the index is 7% for the year, then you're going to get 7%.
Right.
That's going to be your effective interest rate on cash value in the policy. If, on the other hand, the S&P 500 is up 25%, you're going to cap out. You're going to get 10% as your corresponding interest rate paid on cash values in the universal life insurance policy.
Right.
Now, when it comes to building proposals and projecting cash values, because of this variability, we have to have some way to look at the plan and speculate on what cash value growth will be.
Right.
Because it's going to change every single year in reality. But just like we can model projections for real investments in the stock market by assuming a certain interest rate will be earned effectively over the course of several years, we can do the same thing with indexed universal life insurance.
Right.
And we can say, okay, given the parameters, the cap rate, the floor, this is what we think will happen. And we can plug in an interest rate that is assumed in all years that generates the values that we think are most closest to reality. And that's what we do. Now, for years, the interest assumption was left very much up to interpretation.
That's a nice way to put it.
Insurance companies were allowed to basically say, okay, this is the current floor, this is the current cap rate. And if we go back 30, 40, whatever number of years we want to,
whichever one looks best,
and look at what the average index earning would have been over that period of time, given our floor and our cap rate, that's the maximum amount of interest that we can assume.
Right.
And most departments of insurance looked at that, blessed it, and we moved on.
Until they didn't.
And then a couple of years ago, we had a bit of a regulatory initiative that changed that.
Right.
And it said, well, we're gonna define the period that you can use to set the maximum, and furthermore, we're going to use another sort of test here. And that test is going to be a certain percentage over your average yield on assets over a certain period of time. And so it's going to be the lesser of those two things, either a period look back or the corresponding yield on your assets with a little bit of an increase over that to accommodate for the fact that you're generating return through options and not just the other assets inside the general account.
Right.
And that effectively pulled the assumed interest rate down.
It assumed it pulled down the maximum assumed interest rate.
The maximum assumed interest rate.
Yeah.
Didn't change the functionality of indexed universal life insurance at all, but it changed what could be projected.
Right. Prior to that, we was not uncommon for us to see projections of 8%.
Yes.
Or
more.
Give or take, right? Yeah. Which we should add, we never went along
and
with
we
that.
would even point out that there were times that I think certain indexes were created, proprietary indexes, that sort of gamed the system a little bit and allowed companies to assume higher interest rates.
Well, it turns out if you cherry pick your historical data, you can justify just about everything.
Yeah.
In some sort of way.
Yeah.
So
and build an index around it.
Yep.
So there are a couple problems with that approach. Just saying, okay, historically this has been the average indexed credit earned.
Right.
And so you can use this number.
Right.
The problem is when you take that average and just make it a static assumed rate of return year over year,
Yes.
you'll discover that variability affects the ultimate results.
Absolutely.
And what I mean by that is we had actually proven in prior discussions on the Insurance Pro blog that you could take a company's stated average over a 30-year period, its maximum illustratable amount, and you could take actual results from the S&P 500 over a similar time period. And what you would discover is using the sort of back testing or layover results, you would achieve less favorable results in the policy than you could achieve using those maximum illustratable, as we would call them, rates to project values.
Mm-hmm. Mm-hmm.
So in other words, if you just assumed a maximum rate, let's say it was 7 3/4, and built projections on that, this is what the cash value will be, this is what an income solve would look like. Then you went back and you said, okay, let's not use a static number. Let's use the historical values from 1985 to 2005 or 2015 or whatever we want to use, and look at how that compares cash value results, income results. You discover that the actual results are a little bit worse than that static 7 3/4 assumption.
Right.
And that happens because the timing of the actual rates of return matter.
Yes.
Sequence of returns risk is not just something we talk about with respect to how you're going to distribute income from an investment in the market, given variation in returns. But it's also something we have to think about in terms of what our actual result will be.
Of course. Yes. And it doesn't, that risk is not absolved by simply using index universal life insurance.
I'll give you a solid for instance.
It's muted a bit because of mechanics, but
I'll give you a solid for instance that you can listen to in the car. You don't have to sit down and look at the numbers and do any math.
Okay.
That's
my kind of problem.
10-year period. First 5 years, you get 2%. Last 5 years, you get 10%. Now, that's person A.
Right.
Person B, same amount of money, same 10-year period. Only difference, for the first 5 years, person B got 10%. For the last 5 years, person B got the 2%.
Right.
Who has more money in year 11? Person A. Why? Because person A was earning a higher level of interest on a larger sum of money.
Right.
Now, their average return is the same.
Don't let your head explode. Yes.
Average return is the same.
Yes. Yep. And that's that. Not to go way down this rabbit trail, but that's why we've been pounding the table for 6 years now about average returns. Like, it's not that they mean nothing, but it doesn't mean what you think it means.
Correct.
It doesn't have anything to do with the actual amount of money that you have.
No, because the timing of the actual return matters.
Yes. And you gave two very simple examples, right? Just in the inverse of each other. But there's all sorts of other combinations where you could also mix the returns up and get the same average return and have varying amounts of money at the end of the period in all of those scenarios.
Yeah. Well, this is why so sometimes we have conversations with people who own indexed universal life insurance, especially when they've recently bought something.
Right.
And this is a conversation that I think any experienced investment advisor would have with clients who had just opened up a small-ish investment account. If the market doesn't do well immediately after you open something up, it's not really that big a deal and not really that impactful on where you'll ultimately end up. What's more dangerous is when you get bad years later on.
Right.
Because that's when results are augmented.
Right.
People who just started their first IRA with $5,000 in it in 2008, it wasn't that big a deal.
Right.
People who had $5 million in an account that went through 2008, much worse situation.
Right. as a percentage could be exactly the same, but you're correct. So if all that's, a part of the risk, then what gives IUL? This is an unscripted question, obviously.
Yeah.
But what gives IUL a leg up? I know that's not what we're really talking about necessarily, but
right. So, but real quickly, the leg up is just not the ability to go negative.
It's if you have the $5 million,
there's a stop
in the IUL policy.
Right.
You're not gonna lose 40% of your money.
Right. But to kind of shift back to the main subject, the reason we went through all of this discussion is to get to the point where we can say that the interest rate that we assume on index universal life insurance policies is not a number that we are assuming will be the average.
Right.
We don't expect to put index universal life insurance policies into force in 20 years from now, look at it and go, yep, it did it. That hit the number. That's not the plan.
Right.
The sort of, or not sort of, the reason behind the number is to create a variable that we can plug into this equation that gets us to where we think this thing's going to go.
Right.
And that number is derived from a whole lot of calculations and thought processes that take place behind the scenes with us.
Right.
And so we want to be very clear in pointing out that whatever number is being used, if this is done correctly, it's not about assuming that's what's going to happen. So if you're looking at index universal life insurance, either as a practitioner, an agent, broker who's being given a proposal from a company, or you're a buyer, a prospect for life insurance, looking at a proposal and saying, okay, the agent sent me this figure and I want to know what the justification is behind this assumed interest rate. If that discussion starts with or involves really much of, well, for the past 30 years, this has been the average indexed credit earned, you're headed down the wrong road.
Yeah.
We shouldn't be justifying the indexed assumed interest rate with 30 years ago to today, this is what the average was, and therefore we can assume that in a linear fashion for the next 30 years.
Right. Any more than you would do that if you were buying an S&P 500 ETF.
Correct.
Or, I mean, you might do that, but we're telling you probably shouldn't do that.
Right.
Because it's, well, you're either, there's actually one of two things that'll happen if you do that, right? One is you'll be very much disappointed, or one, you'll be elated.
Yep.
But the number in the middle, which is the one that you calculated, is the one that will be wrong.
Mm-hmm.
For sure. I mean, there's no way to look at it. Look, there's a whole nother discussion, and maybe you're headed there. When we talk about averages, if you go back and you look at historical returns, I won't even talk about IUL. Just look at the S&P. In general, it's not a lot of, you don't have a lot of 4 and 5% years.
No.
Right?
You don't.
You have years where you have 25, let's call it 25+% positive returns, and you have years where you have negative 25% or negative 40%. But there's not a lot of bumping around at the average.
Yeah. There isn't, and I would speculate that if there was, indexing for insurance products, indexed universal life insurance, indexed annuities, wouldn't really be able to get off the ground. At least not in the fashion that they do today.
Okay.
Because that volatility and movement in the market is a crucial step to making the derivatives contracts that must be bought to make this happen valuable enough to create the money needed to pay the interest.
Yep. Very true.
If an insurance company is going to buy a derivative on the S&P 500 market, or the S&P 500 index as a whole, and the realistic expectation is it's probably not going to go up any more than 7%, there's not going to be enough value appreciation in that contract to create an interest rate anywhere near 7%
Right.
on an indexed universal life insurance policy.
Yeah.
Now, I want to be
I
clear,
agree with you.
and I want to point out that I don't want people to hear something I'm not saying here. That doesn't mean that the insurance company is screwing you and taking advantage of the fact that they're earning more money than they're paying you.
Right.
Because there's a rampant tendency for people to hear what we're saying now and to pervert it into, oh, you mean there's more money that they're not giving you. No, that's not what we're saying. We're saying in the world of options pricing, in terms of how those options change in value, there needs to be more movement than just a couple of percentage points.
Right. Well, time and volatility are very much factors in the pricing of those. So
They certainly are. The other thing that I want to point out is the model that we have used to kind of speculate on what interest rate should be assumed also takes into account that things change.
Right.
5 years ago, if we were to give you an example of how indexed universal life insurance works, probably wouldn't use a cap rate of 10%.
Right.
Because back then, cap rates were a lot higher than 10%.
Yeah.
Today, that's about average.
Unfortunately.
Now, when we have looked at how these things might unfold, we've taken this sort of movement into consideration. If I were to go back and use the strict math at current cap rates, I could still assume higher interest rates than we do.
Yeah.
But we want to assume that they might go down from here.
Right.
And if that happens, it doesn't change our expectations immediately.
Right. Well, the general trend in cap rates over the last 5, 6, 10 years, probably, if I could stretch it that far, has been down.
Yeah.
Now the good part of that bad news is that means they can also go up.
Right.
When market conditions allow. So
they can. They certainly can.
okay.
I want to speak again quickly to the whole difference in terms of average versus what we would call the geometric mean of something,
Right.
which is basically the compound annual growth rate. This is a figure that you get from. This is a figure that more perfectly speaks to what kind of real return you got on money over a period of time.
Right.
And I want to, even though we swore we would never mention his name again, we're going to break that rule because there's a wonderful example that speaks to this. Not at all related to insurance, just related to investments in general. Several years ago, I do not remember the name of the writer, but there was a financial press guy, maybe for Investopedia or some other financial resource that I'm forgetting the name of, who had written a piece very critical of Dave Ramsey.
Right.
And the core of his argument was that Dave would use averages as a number to sort of speculate what someone would get if they invested in the market.
Right.
And he'd use 12% because he would point out that over a 20-year period, the average rate of return on the S&P 500 was a little over 12%. And this individual's sort of counter to that was, but the geometric return is way lower than that. And he actually took Dave to task. He actually was invited on the show. and this individual asked Dave, and Dave freely admitted that, well, yeah, you're right. The geometric return is more like 8, or geometric mean is more closer to 8, and the average is 12. This guy asked, well, why not use 8 instead of 12 if it's more realistic? And Dave basically told him, because it's my show and I'll do what I want.
Right.
But here we have a clear admission from somebody whose opinions are relatively well received among a large group of people, that there is a big, big difference between the two.
Yes.
And you have to realize that if you are using assumptions that are built on averages, just the pure averages, by taking a set of data that looks at what the return is over a certain period of time and adding those up and multiplying it by, or excuse me, not multiplying, dividing by the number of years, you're going to get a figure. But if you use that figure to speculate on what your results will be over a period of time into the future, you're very likely to be incorrect.
Right.
It's got a high probability of overestimating what your results are going to be.
Right.
Because that sort of math does not take into account the impact the timing of those returns has on your ultimate results.
Right.
And it plays a crucial role in figuring out what you can assume will be the results for not just a standard investment, but for an indexed universal life insurance policy designed for cash accumulation.
Right. Okay.
Not so sure there's much else that we have to add to this.
I don't have anything else to add to that. I think you covered it.
Cool. Yeah. It's always good for us when we can bug out early. With that, yeah. I am Brandon Roberts.
And I'm Brantley Whitley.
And we will be back next week.